Okay, so the banking crisis that's going on. So there's a lot of videos out there. There's a lot of content. I just wanted to keep it simple. And so, I follow people I recommend to follow is definitely Jeffrey Snyder from Eurodollar University. He's on Twitter and he's on YouTube. So he looks at like global credit market implications. He looks at the JGB, the Japanese yen central bank. He looks at the ECB. He looks at German treasury yield inversions. Macro Alf. Alfonso. He also does something similar. His is more of like a specialty on Europe, and he also pays attention in the U.S. But I think Jeffrey Snyder, even though maybe 40 or 30% of it might be marketing, for the most part, he has the correct long term bias. And then, but he doesn't look at like domestic fundamentals. He mostly just looks at global credit fundamentals. And I think that's a really good base. And then this guy, Eric Bashman, EBP Research, he's on Twitter and YouTube. This guy has a method of looking at domestic United States key fundamental indicators, and with that, he comes with a bias as to the direction things are heading fundamentally. And when Eric and Jeffrey Snyder are in alignment, then man, I just really get pumped about just the whole confluence, the whole confluent uh, conclusion. So, uh, continuing on, and after the recommendations, finishing this newsletter, he's basically saying inflation pressure is coming down, except shelter. Coincident growth remains in pre-recessionary and early stage of recessionary territory. So it started in December and pre-recessionary, I guess, uh, indicators, and then now early recessionary territory. Leading indicator to continue to decline for growth, suggesting recessionary pressure will be ongoing. And then he makes a note about the banking crisis, and then he expands. So, Fed balance sheet, the Fed and FDIC did their thing. This will not be confused with QE or monetary stimulus. It's a loan. And we'll see by Darius Dale from 42 Macro just how he explains it. But that is the real way of just seeing the aid that's coming from the government and the Fed to the banks. It's not stimulus or QE, it's sterilized QE. There's a duration on these loans or the money that's exchanged for the collateral at par, and the duration caps the movement of the money and what it could be used for. So, the biggest thing on this newsletter is that there's competition for the small banks with T bills, and the money market fund is the other thing that participants would look to, but they're scared with their money in a regional bank. And they want it to go to a bigger bank, so that's putting fragility risk on the regional banks, exposing weakness on the asset side of their balance sheet. Banks are now bringing this impaired collateral to the Fed and get cash to meet deposit outflows. So it's all an outflow problem, whether it's outflows of like the index funds, outflows in banks. Like, these outflows present fragility because the banks, they position trade, so they don't like to realize losses. They just like to have unrealized losses until the unrealized loss goes away, and that's, they treat pretty much everything as like a bond. Like, it's just a matter of time before it hits maturity and hits profit to where they can make the loss go away and actually get on the winning side of it. So because they have all that money, they can do position trading and have unrealized losses. But these unrealized losses at this certain time where deposits are outflowing presents it to where it's almost impossible to do position trading with assets. That's kind of what they're doing right now. And this is the leading to that fragility as deposits leave, uh, flight to safety. It doesn't, it doesn't lead to market. Credit creation, significant tightening in lending standards, credit crunch, deflationary stuff. So if you hear stuff about inflation, it's more going towards deflation because it's sterilized QE. It's not necessarily like the traditional QE, and that's explained by Darius Dale here.
And that pivot's great. So clearly, what the market is effectively betting on here is that, hey, look, the Fed's about to pivot, and that pivot's going to.
So he's another person I would put in my corner of just credible people to listen to. You got Jeffrey Snyder, EBP Research with Eric, and then Darius Dale. Those are like the top three people I listen to, and I swear up and down just by their expertise.
To be supportive of inflation expectations, so let's all go out and speculate in speculative assets like silver, Bitcoin, etc. Let's go buy stocks because JP Morgan's put a big headline on the tape. We are very much against that view. It's our belief that the Fed is very much not about to supply liquidity in a meaningful way to the markets. And when I say meaningful, it's because the Fed's the bank term funding program is effectively sterilized QE. This is not the kind of QE where the Fed removes duration from the market. We now have bank reserves or bank deposits, whoever used to hold those Treasury and agency securities, that must now go out and put money into respective risk assets and credit. They can buy investment grade credit. The guy who owned the investment grade credit now goes and buys high yield credit. The guy who owned the high yield credit goes and buys stocks. The guy who buys stocks, who sold the stocks, now goes and buys Bitcoin, and so on and so forth. That's how traditional QE works. How the bank term funding program works is the Fed values your security at par, gives you a loan to meet obviously contagion risk in your deposit base, and eventually that loan has to get paid back a year from now. And so that money is not going to be going out there creating deposits across the financial sector that obviously ultimately lead to speculation and risk assets. It is an effective form of QE, but the most important part of what I'm about to say is it's sterilized. The money is sterilized. It has to be paid back. It's being used to support deposits. It's being used already, basically. It's not open-ended QE, the QE we're used to in terms of Bitcoin moving to 69,000, et cetera, et cetera, et cetera. So be very careful about these headlines. I'm going to be here to help you guide you through these, through this process. But if we can, make one final point before we transition to my loan book explorer, which is the Fed is a.
Okay, so then he's going to expand upon like the Fed and their role, and just kind of what's going on. But the conclusion of just everything we've looked at, we went through the newsletter. I told you I recommended who to listen to. But in terms of my thoughts about the banking thing, we have no idea what's going to happen. We just know that for the most part, the Fed has tried to save a sector. And they saved a sector by providing these duration loans. And they also said that Yellen, in her testimony, that people who are over $250,000 of the FDIC insurance limit will not be saved. The people in Silicon Valley Bank were exceptions, and that's that. So there's fragility in the system, and that was known already. Like if you just follow any of these guys, especially Jeffrey Snyder, he's talked about the Eurodollar inversion curve, which is a flight to safety. It's basically people hedging. Reverse repo is the view from the lender. With that being elevated, there's flight to safety with the dollar holding or being elevated, or the huge run up we had in the dollar. Flight to safety. XLY versus XLP, flight to safety from the consumer. So like this was coming. I positioned the portfolio in February, which was a mistake. just got a huge squeeze on it. But fundamentally, it was correct. It was assuming that if we hit early recessionary indicators in December, according to Eric, then it would follow within the coming months, and it's just now showing the cracks in this March. But the conclusion is like we don't know what's going to happen to like period, but we know things don't look healthy, and the evidence, the black hole theory, look at to find a black hole, you need to find just a core group of evidence, multiple points that are saying, hey, a black hole is here, and there's multiple points at saying that, hey, it's not looking good. The whole decision by the Fed Wednesday is almost like it doesn't. We don't need the result to know what's coming, and uh, you know, obviously some might say, well, if QE starts, then it might avoid the problem entirely, and we just don't know that. And I just wanted to kind of put you at ease with the news cycle or just the videos out there. We just can't predict what's going to happen, but we can be prepared with our risk of risk exposure, and it just doesn't look good for risk on behavior until things have settled, until the dust has settled. So I'm like sorry for anyone who has to pitch to get inflows into financial instruments, because it's going to be really difficult for them, just because it's like flight to safety everywhere. The Japanese yen, the U.S. dollar, the Treasury bills. There's all this competition with inflows, and it's just a lot of outflows. And that flight to safety is real. So if you need to prepare yourself, definitely assess your risk, exposure, and what could be lost. That's technically how you determine the number, risk and a number to that definition is how much you could lose. And if you wanted a measurement in the S&P 500, 20-25% drawdown on the S&P 500. I don't know what that is for each stock and how that affects the portfolio you have, but definitely that's the potential of what's coming. I don't know if it's bigger. Darius Dale has a similar kind of thesis of what's coming and market behavior, which is we have some kind of short interim spike down to he's now adjusted his target lower to 2,800. I'm thinking still 3,000, 3,200. I have no idea. I just know just generally that's what I'm looking for to satisfy me to switch bullish. And then we'll have like a kangaroo market. We'll jump back up. I don't know how high, but it's enough to monetize if you're trading or trade investing. And then a bigger drop come early, Q3 2023 or 2024, or starting in Q3 2023 going into 2024. I have no idea, but that's kind of the thesis that I've gotten with either the market structure or the Williams forecast tool that I got, and or just the timing solutions, and just trying to play with that and what it forecasts. But obviously I have no idea. This is all a best guess, but the risk is real. Risk is the amount of loss you can absorb, and you definitely have to put a number to that, what that is, and making sure that it's as small as possible. If we quote Warren Buffett, I think he's overrated, but he definitely says that's the number one rule, is to not lose. And basically that's kind of what I'm telling you. Not financial advice, but just a good general principle. It's just to cap your losses, to make it small. And I don't know. I mean, if there's anything, I mean, that's the number one rule, according to Warren Buffett, to kind of de-risk myself and put some disclaimers. But yeah, that's how I view the banking crisis. What's happening.